Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. The S&P 500 and the NASDAQ end at record highs Thursday. Investors watching Washington for any news on trade policy and also watching big tech earnings. At the end of the trading day, the S&P 500 and the NASDAQ ended the day up. The Dow closed the day in the red. And a mixed Q3 earnings report from powerhouse financial firm Raymond James, hitting record net revenues of over $10 billion. We're speaking with the CEO about the company's performance and future. And entertainment conglomerate Paramount paid up millions in a lawsuit with President Trump. But is that storyline over after the settlement? We're taking a deep dive into this fight. Well, shares of Raymond James Financial is getting a boost today following a mixed earnings report that saw the quarterly revenue grow 5% and top expectations. Paul Shoukry, Raymond James CEO, joins me now with more on those results. Paul, it is good to see you. So you reported, Paul, investors like what you had to say. Stock finished up nearly 4% in today's trade. Walk me through the results, Paul. What are you seeing in the business?
Josh, great to be here. Really pleased with the results that we generated in our third fiscal quarter. As you said, revenue's up 5%. But if you look at the first 9 months of the fiscal year in particular, revenues of $10.3 billion are up 10% over last year's record. So really a great year, testament to our diverse and complementary businesses, and really all the great work that our financial advisors, investment bankers, and professionals do for our clients each and every day.
Taking a step back, Paul, I am interested to get your thoughts on where you think we're at, where we stand with this U.S. economy. You have interesting line of sight there, of course. It does seem to be, Paul, proving resilient here, but I'm curious to get your take.
Oh, you're absolutely right. The United States is the most resilient economy in the world, and it's been incredibly resilient over the last 15 years, really, since the financial crisis. And so long term, we remain very optimistic about the economy. Right now, unemployment's very low. There's a lot of jobs available. The consumer remains strong. Inflation's moderated following the boost during COVID. And so long term, we're very confident about the economy. Short, intermediate term, there's a lot of variables and there's certainly some uncertainty, but we certainly remain confident about the long term. And what we focus on and what our financial advisors focus on with their clients is making sure that they're invested in their portfolios in a diversified way that helps them weather the storms over the near term to achieve their long-term objectives.
Also interested, Paul, to get your take on the general deal-making environment, what you're seeing there. You know, the expectation, of course, Paul, you know, Trump comes back to the White House and okay, here comes the M&A party, then tariffs. And I had folks on the show saying, well, now the concern is people are going to hunker down. They're going to get more cautious. What are you seeing?
It's a great question because that sentiment has been swinging a little bit like a pendulum over the last 6 or so months. The pipelines for M&A across the industry and certainly at Raymond James continues to build and continues to grow. There's a lot of pent-up demand from both buyers and sellers of companies, particularly from private equity firms and financial sponsors that have raised capital and want to deploy that capital, and also sellers that have invested in companies. And over the last couple of years, with the rapid rise in interest rates, there was sort of lackluster deal environment for the last couple of years. So there's a lot of pent-up demand. We came into the calendar year expecting a significant amount of realizations. And then with the uncertainty and shock, really, from Liberation Day in early April, that put a halt, kind of a grinding halt to M&A volumes across the industry. But now as that shock is wearing off, we're more optimistic about deals getting done over the next quarter or two, much more confident than we were over the last couple of quarters.
And finally, Paul, you know, listen, the stock market, as you know, it has been on a roll here. How do your clients feel about it, Paul? What are they telling you? Are they happy with that guidance they're getting from those financial advisors, Paul?
That's a great question. I'm here at our Summer Development Conference in Orlando, Florida. It's an annual conference where over 1,000 advisors, family members, and children attend, which is really unique to Raymond James. I've been speaking to hundreds of advisors over the last couple of days, and they're expressing a lot of satisfaction from their clients. Actually, our internal surveys show 97% of client satisfaction with their financial advisor. Consumer sentiment and investor sentiments increased from 52% last quarter to 68% this quarter, dramatic increase over the last quarter. So clients are confident about their relationships with their financial advisors. They're pleased with the service. We just won #1 for J.D. Power Service Award, and most importantly, the most trusted firm of any advisor-led firm. So our advisors have great relationships with their clients, and client sentiment has improved, and they're confident about their long-term financial plans. And I also want to mention we're celebrating here at our Summer Development Conference. Last night's earnings results was our 150th consecutive quarter of profitability through financial crises and other things, which again is really a testament of that long-term perspective we have, our financial professionals have, and keeping clients first and foremost.
I am curious, Paul, in that market, you're competing against a lot of very smart, effective, competent firms with a lot of smart, effective, competent financial advisors. What do you think you bring, Paul, that's different? What's the competitive advantage there?
We're an extremely competitive market environment. What our competitive advantage is, you see it here at our conference, is the culture. We call it the best of both worlds value proposition. We want to be the absolute best firm for financial professionals and their clients. And we do that by offering the scale, scope of capabilities, technology. The technology demos are behind us. We spend $1 billion a year in technology, but coupling that with the family-friendly culture that we have at Raymond James. And as those financial advisors affiliate with Raymond James, which we're leaders in having them affiliate and retaining those advisors, they bring their clients over and provide excellent service to their clients as well.
Paul, great to see you and to have you on the show. Thanks so much for your time.
Thanks so much, Josh. Appreciate your time as well.
Well, media titan Paramount, which owns CBS, and recently said it's canceling the top-rated Late Show with Stephen Colbert. The decision puts Paramount in the fraught corporate position of picking sides in one of President Trump's many disputes over business and cultural priorities. For more on the feud between President Trump and Paramount, let's welcome in now Yahoo Finance's very own Rick Newman. Rick.
Hey, Josh. This kind of feels like a corporate disaster in the making. It's complicated, so to try to simplify here, Paramount is trying to get this merger done with Skydance. They agreed on this deal last year, and there was no reason then to think they would have any trouble getting government approval for it. But since Donald Trump took office, he has changed the FCC, the Federal Communications Commission, in a way that it is no longer rubber stamping things that maybe it used to rubber stamp. And as it turns out, Trump has a personal grievance with CBS because of the interview they did with Kamala Harris on the 60 Minutes news program last year. He actually personally sued CBS over that because he said it was unfair. It favored Kamala Harris too much. So I think Paramount which owns CBS, was expecting they'd get FCC approval for this deal early this year, and they have not gotten it yet. So Trump seems to be holding it up. So what does Trump want? Well, Paramount just agreed to pay Trump $16 million to settle that lawsuit. And then they cancel the Colbert show. So Colbert has been a regular critic of Trump on his show. So it kind of, no one has come out and said it, but it kind of looks like maybe Paramount is trying to further curry favor with Trump by by canceling a show of one of his prominent critics. But Colbert is going to stay on the air for the next 10 months. They have to honor his contract, which goes through May. So Colbert has said, okay, the gloves are off for the next 10 months. So what this means, I think, is that Colbert is just going to be picking on Trump and on Paramount on a regular basis. Now, he's been going after Trump the whole time, but he has never really been attacking Paramount until recently. So, okay, look at this. So Paramount is going to have to be explaining to Trump why it is still hosting a program with a guy who is attacking Trump on a regular basis when they said they were going to fire Trump. Are they going to get their FCC license and finish this deal? Who knows?
We shall see. Thank you, Rick.
See you, man.
Stick around. Much more Ask for a Trend still to come. The S&P 500 notches a fourth consecutive record as Alphabet earnings fuel AI hopes. Here with the trading day takeaways, Yahoo Finance's Jared Blikre. Jared.
Thank you. I was watching the VIX today, so I'm going to lead with that. Volatility still dropping very slowly, but nevertheless dropping there. And we saw the VIX with a 14 handle, and it closed in the 15s. But I just thought I'd pull up a chart here so we can see. And this is the 4-day price action, and there we go, just slightly below 15. And here's the year to date. This is the one that matters. Here's that huge spike that we saw post-Liberation Day at those lows, and we have just come down really nicely and been trending ever so slightly down. And what that tends to do is it produces a stock market that looks like this. This is the S&P 500, and things have gotten a little bit boring in the indices, and that's what you expect. Low volatility, volume tends to dry up, especially in the summer, except for some of these exceptional options expiration dates or rebalance dates. But for the most part, it's been a somewhat boring market. You got to look under the hood for the action, and that's what we try to do here. But I'm not just looking at the VIX, I'm also looking at the bond market volatility, and this is the ICE BofA Move Index, and this has come down nicely as well. And here we saw a very similar spike around a very similar period of time, and this is based on treasuries. And so you can take a look at the 10-year T-note yield that has come off of its highs around 4.5% from last week, or the 30-year, which has been trying to stay below 5%, and it's been largely successful for most of this period of time. But these are the things I'm watching, and so you put it all together with the U.S. dollar. U.S. dollar is still hovering around those lows, not making too many waves itself. Kind of a quiet market.
Anything, Jared, on the fringe, the market's edge that's on your radar?
We got some meme stock mania. Yeah. Now, we didn't see the upwards movement today, but remember, the other half of the meme stock mania, that was to the downside, and the downside lasted a bit longer. And so this is our meme stock heat map, and let's pull this up. There we go. And there are a few names. For the most part, I created this in early 2021, but I've added some names since then. Circle is a brand new entrant. It's kind of meme-ish. Open is in there, and D-Nut, that's another one that's been, Krispy Kreme has been catching some headlines. So you're going to see a lot of red today, and some of this is outsized red. But as we were talking about last week, let's take Carvana for instance. This is a max chart. This thing was left for dead. This was down 99%. Now it's up, what is that, 100x, so basically 1,000%. Just incredible price action. That is the extreme, but let me just show you what has happened over the last month. And you're gonna see a lot of green here. Coinbase, that was a meme stock from its IPO day, basically, entry into the market. Robinhood also came into being a little bit after the meme craze, but kind of a poster child for the meme craze. So that's in there as well. And I'm including these things because it just kind of highlights the fact that there are some pockets of froth in the market. You could even throw some of those crypto markets in there as well. And why do I mention this? Because it relates back to the fact that the indices that are so boring with this low volatility, you got to find the action somewhere. So people go into the options market, people go into these meme stocks and the like. Crypto's in there as well.
Another topic you have been hitting on has been narrow breadth. And I want to get your thoughts on, like, how much of a concern would you characterize that for the rally?
Yeah, I would say that's probably a yellow flashing warning sign right now. It's not too concerning. I actually had the chance to sit down with Jeff Hirsch. He is the editor-in-chief of the Stock Traders Almanac, and he has his own podcast. And we were talking about bottoms versus tops in the overall market. And the bottoms are really a lot easier to see in real time. Those April 8th lows, I'm not saying it was easy, but it's easier than trying to predict the tops. And he digs into some of the reasons why right here. Let's take a listen.
Tops are a lot harder to call than bottoms. Bottoms are a reactive period. That sentiment indicator stuff that you were mentioning works very well at bottoms. Bullish indications can stay bullish for a long time. We can see that capitulation like we did in April. It was pretty clear. We look at new highs, new lows, advanced declines. We combine fundamentals, technicals with our seasonal work, monetary policy, and sentiment. I look at investors' intelligence, bullish and bearish present advisors, which has been great again at bottoms. At tops, it's very hard to call tops.
And you can find that live on our website, Stocks in Translation. That episode just dropped today. Jeff Hirsch.
All right, thank you, buddy. Appreciate it. Stick around. Much more Ask for a Trend still to come. Well, Keurig Dr Pepper's U.S. beverages saw double-digit growth in the second quarter, led by soda and energy drinks, while its coffee segment faces pressure from inflation and tariffs. CEO Tim Cofer joined opening bid host Brian Sozzi to discuss the company's latest earnings beat. Take a listen.
It was a good quarter, and overall, as a company, we delivered north of 7% sales growth and double-digit, north of 11% EPS growth. So I think in today's, backdrop, we feel pretty good about that. I think to your question on U.S. refreshment beverage, this is our largest reported segment. This is a $10 billion business growing at double digits. And what you see underneath that is really two things. First of all, is a core base business that's really firing on all cylinders. And that's underscored by our carbonated soft drink business, our soda business, flagship Dr Pepper, throwing off another great quarter of growth, gaining market share. You're seeing market share gains for brands like 7-Up, Canada Dry. The other element is some of the newer additions to the portfolio, most notably energy. And last year made a big acquisition for Ghost Energy, really making a play in energy. Energy now for us is $1 billion business in net sales, growing high double digits, and feel great about that new move. Those are the two elements underpinning that strong double-digit refreshment beverage growth.
How sustainable are double-digit gains in that U.S. refreshment business?
We feel good about what we've done front half and what we still will do year to go on U.S. refreshment beverage. I think that type of growth we can continue to put up over the next few quarters, underpinned by those two elements. Feel great about what we're doing in carbonated soft drinks. Expect that momentum to continue. And I think things like energy, things like sports hydration with a brand like Electrolit. Electrolit, fastest growing scaled brand in sports hydration, grew at 30% in Q2. So we've got double-digit ambitions, at least for the next few quarters, on U.S. refreshment beverage.
We're going to talk a little bit about the coffee business in a sec, Tim, but there's such a different pace of growth between the U.S., the beverage business and the coffee business. And then you take a step outside of your business, you see what's happening at Kellogg and Big Food more broadly, businesses getting broken up. Have you considered that as a way to unlock the growth in a business like U.S. refreshments that is, it's significantly outpacing what you're doing in coffee?
Yeah, from a coffee standpoint, feel good about the sequential improvement we posted in Q2 relative to Q1. So you see the rate of both sales growth and operating income profit growth in Q2 sequentially improve. This year on coffee, the big feature is inflation. That input cost, that green coffee price is up significantly over prior year, and that's before you even overlay tariffs on top of that. And so inflation is the watch point on coffee, and that's why we've priced on that business, as has the industry. And we're also pulling other levers, as you'd imagine, mix management and productivity. To the second part of your question, look, we love our portfolio right now. We have a dawn to dusk portfolio of total beverage that covers basically every demand state, every need, anytime, anywhere we offer that beverage. And that gives us a lot of benefits in terms of scale from a procurement standpoint with our customers or our retail partners and consumer knowledge. So we continue to like the portfolio as it is. In the end, of course, I'm here to create shareholder value, and anytime there's an opportunity for shareholder value creation, you can expect management and our board will take a look at it.
You've been at this for a while, Tim. You've been in this industry for decades. Would a 50% tariff, as President Trump has proposed on Brazil, which is a main place where we import coffee, does that crush a business like Keurig?
Yeah, tariffs no doubt are a headwind for our business this year. I think we're navigating it well. Overall, when you look at KDP, you see a business that is overwhelmingly domestic based in terms of our manufacturing and our distribution here in the U.S., in Canada, and Mexico, in our primary locations. But we're not immune to these tariffs. We do source goods from outside the United States, and the notable example is the one you gave, which is green coffee. And, no tariff in the world is going to change the United States' ability to grow coffee. 99% of the coffee is grown outside the U.S. It's largely an equatorial crop across Latin America, Southeast Asia, and other countries. We have a sophisticated sourcing approach, but obviously these tariffs will provide incremental pressure as we go into the back half. And, we built that into our outlook. I think the tariff pressure will put some pressure on operating income and EPS in the back half. And yet, as I confirmed last hour on our earnings call, we do feel confident that we can still deliver an on-algorithm performance of mid-single digits in top line and high single digits EPS growth.
Time now for What to Watch Friday, July 25th. We're going to start off on the earnings front. More corporate reports rolling in on Friday, including Charter Communications and Phillips 66. Looking at Charter first here, the telecoms company announcing results for the second quarter before the markets open. Analysts expecting Charter to lose about 80,000 broadband customers in Q2. Now, that would be an improvement from when the company lost 149,000 customers a year earlier. Moving over to Phillips 66, the energy company posting second quarter earnings on Friday. Analysts keeping a close eye on any updates about buybacks, which they expect to remain steady compared to distributions of $716 million in the prior quarter, but it's also dealing with the cost of its $2.2 billion acquisition of Epic, which could continue to put pressure on the company's debt. And taking a look at the trade deal landscape, Wall Street watching for any news on negotiations ahead of President Trump's August 1st deadline. The European Union and the U.S. are heading toward an agreement to set a 15% tariff for most imports. This coming after a Truth Social post from Trump on Tuesday, remember, announcing a, quote, massive deal with Japan that includes a 15% tariff rate and $550 billion in investments. Well, that's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market room stories affecting your wallet. Have a great night.